Section 4.2 Understanding Dividend Payout Ratio, Dividend Growth Investing. The dividend payout ratio can be a valuable metric for investment strategies focused on dividend growth. By analyzing the payout ratio, investors can gain insights into a company's commitment to returning profits to shareholders through dividend payments and assess its potential for future dividend growth. Here's how the dividend payout ratio can inform investment strategies focused on dividend growth. Sustainability of dividend growth. A company with a low or moderate dividend payout ratio indicates that it retains a significant portion of its earnings for reinvestment or other uses. This suggests that the company has the potential to sustain and even increase its dividend payments over time. A lower payout ratio provides financial flexibility for the company to support dividend growth by utilizing retained earnings. Investors seeking long-term dividend growth can focus on companies with sustainable payout ratios that allow for consistent increases in dividend payments. Room for dividend increases. Companies with a low dividend payout ratio typically have room to increase their dividend payments in the future. As earnings grow, the company can allocate a larger proportion of profits toward dividends without straining its financial resources. By targeting companies with low payout ratios, investors position themselves to potentially benefit from future dividend increases and capitalize on the compounding effect of growing dividends over time. Financial health and stability. A company's dividend payout ratio can provide insights into its financial health and stability. Companies with consistently high earnings and cash flows, coupled with a moderate payout ratio, are generally better positioned to maintain and grow dividends over the long term. By assessing the company's financial health alongside the payout ratio, investors can identify companies with solid fundamentals and a greater likelihood of sustaining dividend growth. Dividend policy and track record. The dividend payout ratio can reflect a company's dividend policy and track record. Companies with a history of consistently increasing dividends, even with a moderate payout ratio, demonstrate their commitment to returning value to shareholders. Such companies are likely to prioritize dividend growth and have a shareholder-friendly approach. Investors seeking dividend growth can focus on companies with a strong track record of increasing dividends and a reasonable payout ratio. Industry and sector considerations. Investors should consider industry and sector dynamics when evaluating dividend growth potential. Some industries traditionally have higher dividend payout ratios due to their stable and mature nature, while others may have lower ratios due to their growth-oriented nature. Understanding the industry's norms and expectations helps in setting realistic expectations for dividend growth potential. Market conditions and economic outlook. Market conditions and the broader economic outlook should also be taken into account when assessing dividend growth strategies. During economic downturns or periods of uncertainty, companies may experience temporary disruptions to their earnings and cash flows. In such situations, even companies with historically high payout ratios may reduce or suspend dividend payments to conserve capital. Investors need to consider the cyclical nature of businesses and adjust their expectations accordingly. When implementing an investment strategy focused on dividend growth, investors should conduct thorough research and analysis beyond just the dividend payout ratio. Factors such as earnings growth prospects, cash flow generation, industry dynamics, and management's commitment to dividend growth are equally important. By combining these insights with an understanding of the dividend payout ratio, investors can identify companies with the potential for sustainable and growing dividends, aligning their investment strategies with their long-term income objectives. The relationship between dividend payout ratio, dividend growth, and total return potential is an important consideration for investors. Here's how these factors are interconnected. Dividend payout ratio. The dividend payout ratio represents the proportion of earnings a company distributes to shareholders as dividends. A high payout ratio indicates that a significant portion of earnings is being returned to shareholders, leaving less capital for reinvestment or other uses. Conversely, a low payout ratio suggests that the company retains a larger portion of its earnings for growth, reinvestment, or debt reduction. Dividend growth. Dividend growth refers to the rate at which a company increases its dividend payments over time. A company's ability to sustain and grow its dividends depends on factors such as its profitability, cash flow generation, and financial health. A company with a low dividend payout ratio generally has more room for dividend growth. By retaining a larger portion of earnings, The company can allocate resources towards expanding its operations, investing in new projects, or pursuing strategic acquisitions. As a result, the company can potentially increase dividend payments at a faster rate. Total return potential. Total return potential combines both dividend income and capital appreciation. Dividends contribute to the income component of total return, while capital appreciation arises from an increase in the company's stock price. The relationship between dividend payout ratio and total return potential can vary depending on various factors. Dividend-driven total return. Companies with a higher dividend payout ratio tend to have a greater portion of total return driven by dividends. Investors seeking income-focused strategies may prioritize higher payout ratios, as the dividend income forms a significant portion of their total return. However, it's important to consider the sustainability of the dividends and the company's ability to maintain the payout ratio in the long term. Growth-driven total return. Companies with lower dividend payout ratios typically reinvest a larger portion of their earnings back into the business. This reinvestment fuels growth opportunities, leading to potential capital appreciation and higher total returns. Investors seeking long-term capital appreciation may focus on companies with lower payout ratios, as they prioritize reinvestment for growth rather than dividend payouts. Trade-off between dividend payout ratio and growth. There is often a trade-off between a company's dividend payout ratio and its growth potential. Companies with higher payout ratios may have limited room for future dividend growth, as they distribute a larger portion of their earnings. On the other hand, companies with lower payout ratios have more flexibility to reinvest in the business, pursue growth opportunities, and potentially generate higher returns over time. It's important to note that the relationship between dividend payout ratio, dividend growth, and total return potential can vary across industries, companies, and market conditions. Different sectors and stages of the business lifecycle may exhibit different norms and expectations regarding payout ratios and growth rates. Additionally, individual company-specific factors such as competitive positioning, market dynamics, and management's capital allocation decisions can influence the relationship between these factors. To assess the potential impact of dividend payout ratio and dividend growth on total return potential, investors should consider a comprehensive analysis that incorporates fundamental analysis, industry research, and a forward-looking assessment of the company's growth prospects. Evaluating the company's financial health, cash flow generation, profitability, competitive advantage, and management's commitment to shareholder returns is essential in understanding the interplay between dividend payout ratio, dividend growth, and total return potential.